And we saw the ISM move from over 50 late last year to now 46.3 in the most recent reading. This signals to us that the manufacturing sector is in contraction. Further, if you really dive into the new orders component of the PMIs, which is really the tip of the supply chain, that continues to move lower as well, now down to 44.3. And so putting this all together, again, to us, it signals that corporate profits are likely to continue decelerating as we move through the year. Within the S&P 500, the highest sales and earnings growth companies really led for the quarter. And that's the market searching out businesses with higher idiosyncratic growth as the broader system shows slower growth. So we have systematic growth decelerating.
The point I want to drive home is that the failures that we saw, which were the second and third largest in US history, were the result of your standard bank run, right? Bank runs are a natural equilibrium of commercial banking. The magic of banking is that a client brings to the bank a building, a home, a project, a business plan, and then the bank turns those illiquid and sometimes ephemeral assets into liquid deposits. So banking necessarily involves maturity transformation. However, that maturity transformation also makes the banking system vulnerable to runs, right? Should depositors redeem their deposits in mass, even the strongest bank would be highly vulnerable. In the absence of deposit insurance, the optimal move by a depositor, even one unconcerned with the bank's health, is to run, because they should expect other depositors to run as well. And banks, of course, serve clients sequentially, right? Picture lining up at the teller window. They serve clients sequentially until they run out of assets. So you want to be at the front of the line. So the banking system, flush with these excess deposits and nowhere to put them, right? Loan growth does not rise commensurate with the size of the Fed's balance sheet. The banking system was forced to put most of that excess liquidity into long-dated treasuries and MBS. And lo and behold, right, we had a huge flood of deposits during the COVID era. And despite Fed Chair Powell saying that they were not even thinking about raising rates, inflation took off and they ended up raising rates by 5 percentage points inside of a year, leading those securities that the banks had recently put on their balance sheets to be massively underwater. The problem is really twofold. Number one, these banks had just naturally unstable business models. And two, these banks had an extremely low share of insured deposits. And I think it's the second point that is absolutely crucial. Only 11% of Signature Bank's deposits were insured, meaning they were under the $250,000 limit. Only 14% of Silicon Valley's deposits were insured. So the vast majority of depositors at these two institutions were, for all intents and purposes, unsecured creditors to the bank. While we did not anticipate deposit runs per se, it was our fundamental research process and our predilection for higher quality businesses that kept us from owning either of those two banks. And for the better part of 9 months now, we have been concerned about and discussing internally the intensifying funding and liquidity pressures on the banking system, based both on what we've been observing, right, with the data from the Fed, but also based on our regular conversations with bank management team. You'll notice today, for only the fourth time in the last 86 years, deposits are shrinking. It's a very unusual occurrence. And in fact, they're shrinking at the fastest pace since the Great Depression. If your loans are growing, which loans throughout the system continue to grow today, and your deposits are shrinking, you really only have two options. Number one, you replace those deposits with borrowing in wholesale markets, or you sell securities. Unrealized losses, for the most part, are not figured into bank capital. Realized losses are. So by selling those securities, you're going to materially impair your capital ratios. In some ways, it's Schrodinger's insolvency. As long as you don't open the box, everything is fine. But once you open the box, you have major concerns. outside of First Republic, which you'll remember from one of those slides, they are right there with Silicon Valley and Signature in terms of the uninsured deposit share. I think the rest of the industry is in much better shape, and in my view, existential risk is behind us. And I think we're in the early innings of this game, and I think the earnings reports so far this quarter are confirming that view. That the bank runs may be behind us, but we're seeing a step function change in deposit costs. Clients are very aggressively reallocating their deposits, both for safety and for rate. So looking forward, we expect to maintain this focus on high quality balance sheets, and expect that focus to continue to generate outperformance. Now is not the time to be a hero. The tide is still receding, and we're still learning who's swimming naked, to borrow a phrase.
So the insurance brokers, they're the intermediaries between the buyers of insurance, which are companies, and the sellers of insurance, which are obviously the insurance companies. They operate a commission-based business model. It's capital light, it's highly profitable. They generate free cash flow. Their commissions are based off the exact premium that their customers are paying. At the same time, their cost of goods sold is unaffected by what's going on with inflation beyond the impact to labor. And really important to notice here is that they do not take any underwriting risk as well. So they're really just kind of getting all of the upside on the top line without any sort of incremental risk. So reinsurance companies, they sell insurance to insurance companies. It's the way the insurance companies manage risk in their books of business from large losses, unforeseen events, things like that. And so for the first time in a long time, the reinsurance companies have all the negotiating power. At the same time, demand has increased. It's just the risk of doing business today, continues to go up over time. And so we've seen renewal pricing so far early this year, up 20 to 50% in certain lines of business.
But I'd like to focus your attention today on the alternative asset manager segment, with a particular focus on those with a tilt towards private credit, rather than those with your traditional private equity or leveraged buyout focus. And it's our view that these businesses are going to be the primary beneficiaries of a retrenchment in bank balance sheets. And the reason that I think private credit is going to benefit is, these shops are levered. Their deals are levered 1 times compared to 10 to 12 times at a bank. They have no redemption risk, so capital is committed for the life of the fund, and then the funding on each individual loan is duration matched to the asset. They're getting double-digit unlevered returns on senior secured loans to high-quality businesses that would typically have gone to either the capital markets or to the banks. So we find this space to be one of the most attractive opportunities in the market right now.